Hey everyone, Larry Bailey here with Mortgage Workflow Partners. We're bringing you another weekly mortgage market news update. Today is November 4th, 2024. We're going to be going through what happened last week, October 28th, 2024. Lots of stuff happening here. We've got several stories to go through. We're going to go through job growth stalling in October, private sector job growth surging while wages moderate. We're going to talk about the JOLTS report. That's the report that comes out. It's going to show some labor sector weakness. Consumer inflation is going to make some more progress here in the next story, followed closely by a big jump in pending home sales. The next story after that is home prices hit another high. Third quarter GDP is solid, but still below forecasts. We will cover. There's a family hack of the week to go through. And then, of course, we're going to talk about what to look for this week coming up for the week of November 4th, 2024. Before we get there, remember that if you ever want to learn how to master your Encompass program, whether you're an independent mortgage banker, credit union, bank, or a large organization just using Encompass in your workflow, we are the mortgage workflow experts. That's what's in our name, and we mean it. So reach out to us over at masterencompass.com. We'll show you how to use that platform in the best ways possible throughout your entire workflow. We also will schedule a free complimentary one department review of your choice. We'll go through and interview your team member. We'll go ahead and give you a completed report along with a visualized diagram of what that workflow looks like and where you can spot changes that will absolutely make a big difference in their day and in your company. Let's get into this here. Our first story is job growth stalling in October, and we've got the BLS jobs report here. And the information comes to you from the Bureau of Labor Statistics, and it reported that there were just 12,000 jobs created in October, which was well below the estimated number of 113,000. Negative revisions to August and September also shaved off 112,000 jobs in those months combined. The unemployment rate held steady at 4.1%, though there is important information in terms of rounding to understand that we'll get into here. So the bottom line here is, while Hurricanes Helene and Milton did have some impact on the report, the BLS noted that they aren't able to quantify the impact. There are signs of weakness in the report regarding the storms. Not only was the headline job number, which comes from the business survey portion of the report, much lower than forecast, but the job creation component in the report's household survey showed that 368,000 job losses. That latter figure is considered more real time because it's actually called and derived by calling households, whereas the business survey is based on modeling and estimations. The household survey also showed that we lost 164,000 full-time and 227,000 part-time jobs last month. And there's an important note here on the unemployment rate, which did rise materially, even though the rounding makes it appear otherwise. September's unemployment rate was 4.051%, which was rounded to 4.1%. October's unemployment rate was 4.145%, and while this was also rounded to 4.1% because you round down, it's still almost a 0.1%. It's actually 0.094%, to be exact, as a rise. So there's that. This next story, private sector job growth surges, wages moderate. So this comes to you from ADP, and we see a fairly large jump, right? If you go back to August through September, we see this trend line kind of pop up pretty strongly. In October, the private sector job growth hit the highest level since July 2023 per ADP's employment report. That showed that employers added a much larger than expected 233,000 new jobs. In addition, the breadth of job creation was broad-based, with only the manufacturing sector shedding jobs. ADP called this hiring, quote, robust and broadly resilient as we head towards the new year. Bottom line in the story is that despite the strong headline number, small businesses continue to struggle, as those with 50 than fewer than employees only added 4,000 jobs. This compared to 226,000 new jobs added among medium and large companies combined. Annual pay gains also continued to decelerate for both job stayers from currently at 4.6% from 4.7%, and job changers 6.2% from 6.7%. So that was a 0.5% change in just 1 month, reflecting a decline in wage-pressured inflation. The JOLTS report, and as a reminder, JOLTS stands for Job Openings and Labor Turnover Survey, JOLTS, showed that job openings fell to 7.443 million in August, which was well below forecasts and absolutely well below the 12 million that we hit as a high in 2022. The quit rate remained at a low 1.9%. A low quit rate suggests there's less poaching from other companies and fewer people feel confident about finding new employment if they leave where they are. Regarding unemployment, 216,000 initial jobless claims were filed last week, marking a decline of 12,000 from the previous week, plus 1.862 million people still continue to receive their benefits after filing their initial claim. Continuing claims have now topped 1.8 million for 21 consecutive weeks. Bottom line of the story is we continue to see less hiring, fewer people quitting their jobs, and elevated continuing unemployment claims. Labor sector reports are crucial to the Fed as they weigh their monetary policy and further rate cuts, given their dual mandate, of course, of price stability and maximum employment. Next story is consumer inflation making progress. Now, this is the Fed's favorite measure. Of course, we know this PCE, personal consumptions expenditure. I'm sure you probably never heard this up until the last 12 months. And September's personal consumption expenditure, PCE, showed the headline inflation rose 0.2% from August, while the year-over-year reading fell from 2.3% to 2.1%. The core PCE, which is the Fed's preferred measure, because that strips out the volatile food and energy prices from that, rose 0.3% monthly. The year-over-year reading held steady at 2.7%, remaining the lowest level in almost 3 years. So the bottom line, of course, in this story is the trend of monthly core PCE readings have been favorable and in line with what the Fed wants to see. In fact, the annualized last 3 months readings, the core PCE would be at 2.32%, which is closer to the Fed's 2% target. Plus, shelter costs remain the largest contributor to inflation, and they're still overstated due to the lagging effect. Inflation would even be lower if more real-time shelter costs were being reflected in this reporting. Hey, gang, guess what? We saw a big jump in pending home sales. And again, when you look at these averages, I want you to really pay attention to what's going on here between 2021 and September of 2024. So pending home sales, which are signed contracts on existing homes, rose 7.4% from August to September, hitting their highest level since March. The National Association of Realtors, that's the NAR, also reported that sales were 2.6% higher than they were a year ago. Bottom line in the story is, quote, contract signings rose across all regions of the country as buyers took advantage of the combination of lower mortgage rates in late summer and more inventory choices, close quote. That came from the chief economist of the NAR. His name is Lawrence Yun. He went on to say further, quote, further gains are expected if the economy continues to add jobs, inventory levels grow, and mortgage rates hold steady, close quote. Well, Lawrence, um, we seem to be losing jobs. I don't know about inventory. Last time I saw, we had inventories not growing so much. And mortgage rates, yeah, they kind of went up over the last few weeks. So we'll see what happens here. So this next story is all about home prices hitting another high. Information comes for you from the Case-Shiller home price index, which is considered the quote gold standard for appreciation. It showed home prices nationwide rose 0.3% from July to August after a seasonal adjustment, helping home values reach an all-time high for the 15th straight month. Home values in August were also 4.2% higher than a year earlier, following a 4.8% gain in July. The Federal Housing Finance Agencies, that's the FHFA, their house price index also showed that home prices rose 0.3% from July to August, and they were 4.2% higher when compared to the same time last year. Bottom line in the story, gang, is while home prices continue to appreciate, the pace is slower than earlier in the year. However, homeownership continues to provide significant wealth. Guys, I just want to kind of put these numbers in perspective, right? So if it's 2024, if you had bought a home, if you go back to these numbers here, I mean, this only goes back from May, right? But if you go back and it's 4.x% or 5% higher than last year, and we know last year was enormous. I just want to put this in perspective. If you bought a home for $400,000 or $300,000, I mean, hell, even if it was $100,000, if you bought that 4 years ago and you're gaining anywhere from 8 to 10%, again, depending on markets, the amount of money that you gained from appreciation just by sitting in your home and paying your mortgage is enormous, and it leads to wealth. And these things take time. There's no quick or guaranteed answer to home value appreciation. But one of the things I will tell you that I've watched and also done myself personally is when you find a home that you can afford and you're in the mode of real estate investing, whether that's for yourself to live in or for a way for you to provide appreciation gains in your personal investment portfolio, or if you're trying to buy homes to rent and you're an investor, there's all these strategies. It doesn't mean it's a guarantee. It just means that we continue to see appreciation. One of the things that I've been talking about for years here, at least since 2020, is the fact that every time you continue to wait is less of a chance of you obviously having the ability to increase your portfolio through appreciation. And by less of a chance, I mean it's zero chance because you're not in the market. So as always, I'm always encouraging folks, buy for yourself, buy because you got to live somewhere. Buy for yourself. I said in a post over if you follow me on LinkedIn over the weekend where more and more people are not finding homes that need work because they're not handy. YouTube's a beautiful thing. I've rebuilt a home literally by following YouTube guidance on some things. So sometimes it does require a professional, like for foundation and maybe roofing, things that you're not comfortable with. But there's lots of things happening inside homes that don't require those high level skills that you can learn on your own. And I would absolutely encourage you to find some place where you live and around where you live and see if you can find a home that you can fix up. If not for yourself, for somebody else, and maybe you make a few dollars and you get some experience. So something to think about. All right, back to these stories here. We've got the next one. This is the third quarter GDP. It's solid, but it is below forecast. The economy grew 2.8% in the third quarter, per the Bureau of Economic Analysis, which was a solid but somewhat disappointing GDP reading, gross domestic product, given that forecasts were expected for higher growth. By comparison, we saw 3% and 1.6% growth in the second and first quarters of this year. Bottom line from this one is economic activity in the third quarter was driven by consumer spending, exports, and federal government spending. Note that this report was an advanced estimate, and the data is subject to revisions when the second and final readings are released on November 27 and December 20, respectively. Hey, gang, if you're into the Family Hack of the Week, head over to this spot. If you're listening to this on podcast, head over to this spot in the video that you'll find either on our YouTube channel using Mastering Encompass, or you can get us over at mortgage.community. And this is all about remembering that you really should have an emergency kit. So there's a checklist for basics that you want to go through here. Just a real quick one, of course. These are the things that we all look for in an emergency, and we're like, crap, where is this stuff? Batteries, flashlights, dust masks, a whistle, some kind of moist towel. And this is the thing that gets me: a wrench or pliers, and then of course first aid kit. And there's some other things on here for definitely to read through. One of the challenges, of course, is keeping this thing handy. I would also say it's not on here, but I'd also say make sure you have jumper cables in your car. I just tried to help somebody, and I've got two sets of jumper cables, but I got two cars, but they're both in one car. Makes no sense. So definitely check that out. Here's what to look for this week. We've got the Fed's two-day meeting, which begins Wednesday with their monetary policy statements and press conference following Thursday afternoon. We'll also see home price appreciation data, while the latest jobless claims will be reported on Thursday. I do want to point out up in here, you can't see this on screen, so I'll put this down here. We've got the mortgage-backed security is better by 29 basis points. If we come over here into the candlesticks that I've shared with before, we can see some of these things happening here. This is the cost of money. And if we come down and look at the last 6 months, I don't know if you remember where rates were, like sometime around June. And then we saw everything kind of get better, 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 better. The last time rates were better was sometime around September 19th. And now here's where we are all the way down here, November 1st. Money is way more expensive right now. There was 102.43 for $1 of bond. Right now it is 100.59. So if you do the math here, 102.38 minus 100.55, it's about 1.7, give or take. Let's see if we do that math here. Yeah. So, 2.3 down to 100.5. So about 1.8, 1.7 and change. Worse in pricing. That means for the same interest rate, you're going to pay about 1.7 something, 2 points if you round up, to get the same money. So definitely, like I always say, if you find a deal and you can afford it, grab the deal, because if things get better, that's great. That's when you get to make some fun decisions. But when things get worse, that's when you have to make hard decisions. I like making fun decisions myself. I don't know about you. In that regards, my name is Larry Bailey. If I can help you make a fun decision by helping you with your Encompass platform and your company's workflow, please reach out. You can find us over at masteryencompass.com, mortgageworkflowpartners.com. We'll see you there. Thanks very much. Take care.